gold returns to embody monetary value, traditionally used as currency over centuries and even millennia. Gold ceased to be considered a monetary metal decades ago, becoming a mere commodity. The end of the gold standard was officially announced on August 15, 1971, when Richard Nixon declared the suspension of the dollar's conversion into gold by the US Treasury. In the legal sphere, the break of this link occurred during the Jamaica Monetary and Financial Conference in 1976, in which the IMF member countries announced the uncoupling from the gold standard. In fact, the measures adopted at the Bretton Woods Conference in 1944 were reversed, as the dollar and gold were established as international currencies, requiring the US Treasury to guarantee free exchange between dollars and gold. The Jamaica Conference confirmed that the US dollar remains the only global currency, while gold has been treated as a commodity like oil, wheat, and coffee. From that moment on, the use of gold in international transactions virtually disappeared. Although the behavior of central banks and finance ministries was surprising, those who held gold in their reserves seemed to have it in vain. For some reason, the United States persisted in holding over 8,000 tons of gold in its international reserves. Another curious phenomenon was the surge in gold prices, which reached $800 per troy ounce in the early 1980s. The truth is that the price of gold began to fall, reaching at times to nearly $300. For more than 4 decades, the world has operated without gold as currency. However, some have realized that the gold market has a hidden facet involving constant manipulations of this precious metal. The manipulations aimed at the individual interests and strategic objectives of the main shareholders of the Federal Reserve of the USA, who sought to keep the price of gold low to ensure the hegemony of the US dollar in the world, as a higher price of gold would weaken the US currency. Experienced financial professionals understand the importance of gold control in the global financial system. In the past 4 years, symbolic events in the history of gold have taken place, and soon, another one is expected. It is advisable to closely monitor this situation. Basel III is advancing with another stage of implementation. Located in Basel, Switzerland, the Bank for International Settlements, this acts as the informal central management of the global banking system, serving as a club of central banks. At the BIS, the Basel Committee on Banking Supervision (BCBS) operates, responsible for establishing consistent standards and methodologies for the regulation of banking activities. The first important document, known as Basel I, was created in 1988 by the Basel Committee on Banking Supervision. Subsequently, in 2004, the Basel II document emerged, officially titled International Convergence of Capital Measurement and Capital Standards, a revised framework. In response to the global financial crisis of 2008-2009, which highlighted the lack of adequate resilience in banks, Basel III was approved in late 2010-2011. Basel III has raised banks' capital standards and established criteria for determining and assessing capital. Currently, global banks are adopting the guidelines of this document, which will enter its final phase on March 29th, changing the inclusion of gold as part of banks' capital. According to the guidelines of the National Central Bank, bank capital is distributed across 3 categories. The highest category includes cash, currency, and non-monetary forms. Next are the highest-rated Treasury securities, with a focus on US Treasury securities. In the third and lowest category, gold is considered a form of money. The calculation of banks' equity is done considering the valuation of the gold held by the bank, which previously showed no interest in accumulating this valuable metal due to discrimination. From March 29th, banks were allowed to include gold as part of their equity, being valued at 100% of its price. Gold is being elevated from third to first category, which means that from March 29th it will be again considered a full currency. like the dollar, the euro, or the pound sterling. Despite this, the scenario may seem unchanged after that date, but gold mines will have to prepare for an increase in demand. It is curious to note that, with the adoption of Basel III, central banks have ceased selling precious metal. Central banks around the world became big buyers of gold, increasing their reserves by 651.5 tons in 2018, the highest volume since 1971 when the gold standard was cancelled. This represents a 74% increase compared to 2017, which saw reserves of 374.8 tons, according to data from the Gold Demand Trends Report. World Gold Council. The Central Bank of Russia was the largest gold buyer in 2018, expanding its reserves by 274.3 tons, a record that represents 42% of all central bank purchases in the previous year. In second place, the Central Bank of Turkey added 51.5 tons of gold to its reserves, followed by the Central Bank of Kazakhstan, which increased its reserves by 50.6 tons. Last year, the main buyers were India, acquiring 45 tons, Poland, with 25.7 tons, and Mongolia, with 22 tons. Surprising everyone, Poland became the first country in the European Union since 1998 to acquire gold for its reserves, while the Central Bank of Hungary, which had not purchased gold since 1986, increased its reserves in October of last year from 3.1 to 31.5 tons. However, the representation of gold acquisitions by central banks in the World Gold Council's report is considered incomplete and inaccurate. Experts estimate that in recent years, the main buyer of the yellow metal in the global market among central banks, alongside the banks of Russia, is the People's Bank of China, PBC. However, information regarding the increase in gold reserves by the People's Bank of China is kept confidential. Only sporadically do PBC statistics mention increases in reserves of this precious metal. As of February 2019, the countries with the largest gold reserves, according to official data, include the USA, Germany, Italy, France, Russia, China, and Switzerland. E aqui está o texto traduzido para o português. E aqui está o texto traduzido para o português. Despite the growing demand for gold, its price on the global market fell approximately 5% last year. Investors betting on a significant increase in their gold reserves have contributed to the artificial price drop. The paper gold market is expanding, with volumes exceeding those of the physical metal market. With the increase in circulation of paper money, it is viable to acquire physical metal for a more affordable value, although this situation is momentary. Soon, the trend will reverse and gold prices will start a rapid climb. Therefore, everyone wants to possess gold before this scenario materializes. Amid the rise of gold, other financial instruments will seem insignificant. Participants in global financial markets will adjust their portfolios in favor of the precious metal, reducing positions in debt securities and stocks. Speculators without access to the printer will seek to acquire gold with resources obtained from the sale of government and corporate bonds, as well as stocks. The world is on the brink of a second wave of financial crisis, and the introduction of the Basel III gold standard rule may be the catalyst. For survivors of the crisis, gold may reclaim its rightful place in the world of finance. There is a suspicion that the inclusion of the gold standard rule in the Basel III document was the result of the efforts of the Rothschild clan, which has been dedicated to the gold market for 2 centuries. By adopting the golden rule, they seek to strengthen their fragile positions. The unlinking from the gold standard in the 1970s diminished its weight in global finance. See you soon. Subscribe to our channel and remember to share this video with your friends.